Hello everyone, welcome to another video focusing on accounting. I'm your host, Professor Capko, and today we're going to continue talking about debits versus credits. I'm going to make it super easy for you to know when an account should be debited or when it should be credited on an income statement type account. Now, last time we talked about the assets, liabilities, and owner's equity, which are all balance sheet accounts. And of course, we've discussed in the past, the balance sheet is like a photograph. It's at a particular time, something occurs, or we're looking at what the assets, liabilities, and owner's equity are on that particular date. Now we're going to look at the income statement accounts. These are more like a video. We're going to be looking at money coming in as revenue and money going out as expenses. And those accounts are going to need to be debited and credited just as well. So I set up another chart similar to the last one, and this is going to focus on the income statement items. I've split it in half just like I did the balance sheet, just to make it easier to understand whether you're debiting or crediting an item. So for the income statement, we've got things that are revenues and we got other things that are expenses. So revenues would be sales, fees earned, maybe rent revenues, maybe service revenues, any kind of money that's coming in to a company. We're going to put those on the right-hand side. Companies also have expenses. The light bill, rent, maybe they pay money for their inventory, the wages for the employees, taxes, all those things are expenses. I'm going to put them on the left side. And the reason I do that is I want to line them up with the way we handled things for the assets and liability accounts to show you the debits and the credits. So let's say you have an expense. Maybe it's the water bill. I'm going to show it as a T account. And I'm even going to put the name expense here. They don't always say expense, but oftentimes they do, which will indicate to you that it should be treated as an expense. And again, we have debits on the left and credits on the right. The reason I line it up this way is so it'll match the way we handled the balance sheet account. So you're going to know that expenses are going to increase with debits and they're going to decrease with credits. Now, generally, your expenses are only going to increase. In other words, each month you have a water bill, so each month you're going to be having an increase in the amount of money that was spent on the water bill. These would accumulate, and when you come to the end of the period, whether it's a month or a year or quarter, whatever it is, you're going to add up all your expenses to know how much they are for each item. In general, we're not going to be crediting expenses unless there is some sort of mistake or rebate, something like that. So the credit to expenses would be rather rare. On the other hand, you might have a revenue. Sales, for example. And I'm going to put that as a T account on this side. Likewise, we're going to have debits on the left and credits on the right. These might be called revenue, it might be called income, it just might be called sales. Different companies, different industries call it something different. But the general idea is this is money that's coming into the company as it's providing services or goods or sales. This is not where you would put an investment. So if somebody was investing in the stock in the company, it would not go in revenue. That would go into owner's equity, We're going to treat that in a different video. Since I put it on the right side, like liabilities, even though it's not a liability account, these are income statement accounts, I put it on the right side just to remind us that it's going to increase with credits and it's going to decrease with debits. So every time the cash register rings, we're going to be adding to our sales revenue, and it's going to be on the right hand with a credit. Seldom will we make a debit to sales revenue. In some circumstances, maybe there's a mistake or something like that to correct it. But in general purposes, we're not going to be debiting the sales revenue. This is an easy way for you to remember whether you're debiting or crediting your sales revenue or your expenses account, which are all income statements accounts. If you have any comments or questions, go ahead and put them in the comments section below. Please like and subscribe this video. It will help with the YouTube algorithm, and keep your grade alive, and subscribe. Until next time, this is Professor Capko. Thank you.